Good morning. Grab your coffee, pull up a chair, and let's talk about that notification you probably got on your phone yesterday. You know the one? The contribution successful alert from your 401 key provider? It feels good, right? It's the ultimate adulting ritual. You're being responsible. You're building a fortress for your future, one paycheck at a time. But here's the deal. That fortress isn't as private or as safe as you think. In fact, to the most sophisticated machines on Wall Street, your responsible monthly habit isn't a fortress at all. It's a signal, a loud, clear $52 billion signal. Let's look at the numbers. Total US 401 KILA assets just crossed the $10.5 trillion mark. That's a 45% jump in just 3 years. $10.5 trillion that land for a second. That is a massive towering mountain of capital, and every single month, like clockwork, another $52 billion flows into that mountain from regular people like you and me. It's predictable, it's automated, and in the world of high finance, predictable is just another word for vulnerable. Your slow and steady strategy has created the largest, most consistent liquidity pool in human history. And today we're going to talk about why the machines are treating that pool like a feeding trough. Think about it. You're told to buy and hold. You're told not to time the market. So every 2 weeks, your plan provider buys a basket of stocks, regardless of the price. You're a blind buyer. And while that sounds like a great way to avoid emotional mistakes, it also makes you the perfect counterparty for a trader who knows exactly when you're going to show up. But if your money is constantly flowing in, why does it feel like you're always buying at the exact moment the market is about to slip? Well, that's where the story takes a turn. Let's break it down. Okay, let's talk about the real problem. We've moved past the era of simple if-then algorithms. You remember those? They were basically digital calculators. If the price hits X, sell Y. Simple. But today, we're in the age of agentic finance. We're talking about AI agents that don't just calculate, they reason. They read the news, they analyze sentiment, and they execute multi-step strategies in the time it takes you to blink. Actually faster. The mean time to execution for these systems is now 450 microseconds. To put that in perspective, a human blink takes about 300,000 microseconds. You aren't even in the same zip code as these machines. Right now, algorithmic trading accounts for about 78% of all market volume. But here's the part I find wild. It's not just that they're fast, it's that they're all starting to think exactly the same way. The SEC is tracking something called the Model Monoculture Index, and right now, it's at a level 8 out of 10. Why? Because about 90% of these trading agents are built on the same 3 foundational AI kernels. It's like a stadium where everyone has the exact same internal monologue. This creates a massive systemic fragility trap. Because these agents share the same digital brains, they all identify the same cell triggers at the exact same microsecond. When a piece of bad macro data hits the wire, they don't wait for a human to finish their coffee and think about it. They all rush for the exit simultaneously. It's a synchronized sell-off. And in a room where everyone rushes for the same exit at once, who do you think is left holding the door open? I'll give you a hint. It's the person whose account is set to auto-buy at the start of the month. Imagine a stadium fire where the exit doors are only big enough for 10 people, but 10,000 are trying to get out? That's a flash crash. But in this stadium, the machines have a secret trapdoor, and they've designed the main exit to be blocked by your incoming retirement contributions. It sounds dramatic, I know. But look at the data. We're seeing flash spikes in volatility 4 times a year now, a 300% increase. The math stops working. And when math stops working, the people who own the machines start looking for an exit strategy. And honestly, this is the most interesting part of the whole story. So, who is actually winning here? Let's zoom out for a second and look at the autonomous trading orchestrators. These aren't your traditional hedge funds with guys in fleece vests. These are agentic hedge funds. They use high-speed orchestrators that specifically hunt for passive retail flow patterns. They aren't just trading stocks, they're harvesting liquidity. Here's how the trap works. These agents know that every month, $52 billion of retail money is going to hit the market. They wait for that window. When your 401k plan starts its massive buy order, these AI agents use that predictable demand to exit their own massive positions. They sell their shares to you at the peak price, using your retirement savings as their cash-out insurance. You are literally the buyer of last resort that allows them to get out before the volatility hits. It's a 400% increase in profitability for these firms during low volatility windows. The exact windows when retail 401k buying is at its highest. It's not a coincidence, it's a mechanism. They've turned your responsible long-term saving into their immediate profit margin. This is what we call liquidity harvesting. You think you're investing in the future of the economy, they see you as a predictable exit ramp. And here's the kicker, this isn't just a glitch in the system, it's the system working exactly as it was redesigned to work. We've built a market where the dumb money, and that's what they call us behind closed doors, is automated, and the smart money is agentic. One side is blind and slow, the other is seeing everything and moving at the speed of light. But is this the first time we've built a trap this dangerous? Or have we seen this movie before? Let's take a look back, because history has a way of shouting at us if we listen. 1987, Black Monday. The Dow dropped 22% in a single day. At the time, everyone blamed portfolio insurance, which was essentially the AI of its day. It was a computer-driven strategy that was supposed to protect investors by automatically selling when the market dipped. But because everyone was using the same strategy, it created a feedback loop that nearly destroyed the entire financial system. Sound familiar? Terry Gensler, the chairman of the SEC, has been sounding the alarm on this AI monoculture. He calls it a fragility trap. He's worried that if every agent follows the same LLM logic, a single digital hallucination could trigger a global collapse. And the problem is, our current safeguards, the circuit breakers designed to pause trading during a panic, were built for human-scale fear. They were built to give a guy on a trading floor time to take a breath and call his boss. But AI agents don't need to breathe. They can drain a market's lifeblood and move billions of dollars in the milliseconds before a breaker is even triggered. By the time the alarm sounds and the lights come on, the machines have already finished the heist and moved the money to a different asset class. Nassim Taleb, the author of The Black Swan, calls this a tail risk nightmare. We've built a stadium where everyone is tied together by the same computer code during a fire. If the safeguards are too slow and the predators are too fast, where does that leave your actual bank balance in 10 years? So where do we go from here? This isn't a story about a one-time crash. It's about something much more subtle and, in some ways, more damaging. It's about hidden slippage. It's the tiny, repeated losses that occur when you buy at the peak of AI-induced volatility and sell into a synchronized exit. It's a slow-motion ransacking of your compounded returns. Think about that next time you see your grocery bill or your rent. Every percentage point of return that is harvested by an AI agent is a year longer you have to work. This erosion could push your retirement age back by 5, maybe 10 years. The S&P 500 is more concentrated than it's been since the 1970s, with the top 10 stocks making up over 34% of the index. That concentration makes the monoculture even more dangerous. One glitch in one model at one firm could wipe out a decade of your responsible savings. The machines have already made their move. They've mapped your behavior, they've anticipated your inflows, and they've built a system that treats your retirement as their liquidity. The question is no longer whether the market is rigged. The data tells us that. The question is whether you're willing to keep being the exit strategy for a piece of code that doesn't care about your retirement. I know it's a lot to take in before your second cup of coffee, but in the agentic age, financial literacy isn't just about knowing how to balance a checkbook. It's about knowing who is on the other side of your trade. And right now, it's a machine that's already decided how to spend your money. Think about that today. I'll see you tomorrow.